Oil prices are suddenly surging again, markets are getting nervous, and behind the scenes, one of the most dangerous choke points in the global economy is back in the spotlight. The Strait of Hormuz. Nearly 20% of the world's oil passes through this narrow waterway every single day, and now rising tensions in the Middle East are raising a terrifying question. What happens if that oil flow is disrupted? Because if that happens, this could trigger the next global economic shock. Let's break down what's really happening and why the world is watching very closely. Most people don't realize how fragile the global oil system actually is. The Strait of Hormuz is only about 21 miles wide at its narrowest point, yet it carries oil from Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, and Iran. Altogether, roughly 20 million barrels of oil pass through the strait every single day. To put that into perspective, that's roughly 1 out of every 5 barrels of oil used on Earth, which means any disruption here instantly affects oil prices, global inflation, stock markets, and ultimately, your everyday cost of living. And that's exactly why investors are starting to worry. Recent geopolitical tensions in the Middle East have raised concerns that shipping routes could be threatened. Even the possibility of disruption can trigger oil price spikes, because oil markets operate on risk expectations. If traders believe supply could tighten, prices move immediately. And we've seen this pattern before. In past Middle East crises, oil prices have surged 10 to 30% within weeks, energy stocks skyrocketed, and airlines and transportation companies plunged. Because when oil rises, everything becomes more expensive. Shipping, food production, manufacturing, and transportation. Almost every part of the global economy depends on energy. Remember the inflation surge after the pandemic? Energy played a massive role. When oil rises, gasoline prices increase, shipping costs increase, production costs increase, and those higher costs eventually reach consumers. This is why central banks, especially the U.S. Federal Reserve, closely monitor oil prices. Because if energy costs spike again, inflation could reaccelerate globally. That would put central banks in a very difficult position. They would have to choose between fighting inflation with higher interest rates or supporting a slowing economy. And historically, this type of dilemma can cause major market volatility. Financial markets react to oil shocks in predictable ways. Historically, we see energy companies surge and oil producers and energy ETFs often rally sharply when crude prices rise. Meanwhile, airlines struggle, shipping companies face higher costs, and consumer spending slows. And sometimes the broader stock market becomes unstable. One famous example was the 1970s oil crisis, which triggered years of economic instability and stagflation. While today's situation is different, the lesson remains the same. Energy shocks ripple across the entire global economy. But there's another dimension to this story. Energy is not just about markets, it's about power and geopolitics. Countries around the world are already trying to reduce their reliance on vulnerable energy routes. We're seeing strategic petroleum reserves being expanded, more investment in domestic energy production, and accelerated investments in renewable energy. Ironically, geopolitical tension often speeds up the energy transition because governments realize how risky global supply chains can be. Right now, 3 major scenarios could unfold. Scenario 1, tensions calm down. Oil prices may stabilize if shipping continues normally and tensions ease. Markets would likely recover quickly. Scenario 2, continued instability. If tensions remain elevated, oil prices could stay volatile. This would create ongoing inflation pressure worldwide. Scenario 3, major disruption. If shipping through the Strait of Hormuz is seriously disrupted, oil prices could spike dramatically. In extreme scenarios, analysts say oil could surge above $120 or even $150 per barrel. That would send shockwaves through the global economy. Right now, investors are closely monitoring tanker movements in the Persian Gulf, military activity in the region, statements from major oil producers, and strategic reserve policies. Because these signals often determine whether oil prices stabilize or surge further. The global economy runs on energy. And sometimes the entire system depends on one narrow shipping lane halfway across the world. Right now, that lane is back in the spotlight. If tensions escalate, oil could become the next major shock to the global economy. But if stability returns, markets could breathe a sigh of relief. Either way, this is one story the world cannot afford to ignore. And of course, this video is for informational purposes only and should not be considered financial advice.